All right, so now let's take a look at the producer side of things. So we want to assume that a firm makes its decisions in order to maximize profit. And of course, in the real world, the firms might deviate from that if they want to. For instance, in our one of our discussion threads, we had Amazon and Microsoft were looking to. They did a huge environmental initiative, which might not actually maximize their profit, but I don't know. It depends on how cynical you are, whether or not their goal was to maximize profit or to increase their brand, or whether they cared about the environment. But most economic questions regarding a firm typically are about maximizing profit. Unfortunately, in the real world, it's probably more on the short-term level than on the long-term level. But it's I think, a fair assumption, and the assumption that most economists make, and not always the assumption that you have to make if you are doing like a graduate level paper. But it's probably a good starting point. Okay. And that's really where we start with for producer theory. So we're assuming that a firm wants to maximize its profits, which could be simultaneous with cutting its losses as well, if their profits are negative. Okay. So we define profit as the difference between the total revenue and total cost. And we've seen revenue from the elasticity exercise, as I said in the last slide. But revenue can be defined as the price times quantity, right? Remember, if it's the inelastic part of the demand curve, or if you have an inelastic demand curve in general, and you raise price, your revenue goes up because price times quantity goes up, right? So revenue is the price times quantity. What is cost? Well, cost is what it sounds like. We're just defining cost at the moment as a function of quantity. So the more goods you produce, the more of your item that you're selling, the higher your cost goes. So right now we're just defining cost as a function TC of Q, so that increases in Q. And that's not to say that every unit of Q has the same cost or a higher cost than the prior unit. That would be your marginal cost, which we'll get to later. But the cost of producing one additional unit of, the cost of producing one additional unit of Q is greater than or equal to 0, so that if you produce an extra Q, your total costs go up. Okay. So profit, which is the Greek letter here, pi, okay, is just your total revenue minus your total cost. Oh, if this thing is annoying. It happened the last time too. So profit is your total revenue minus your total cost. It's defined as price times quantity minus this function TC of Q, total cost. Okay. Now, what does that mean? What is profit? We'll delve a little bit into that in the next slide. Okay. So there's different kinds of profit. Okay. And remember, this is going all the way back to lecture 2, but there's different kinds of costs as well. So we have economic costs and we have explicit costs or accounting costs, right? And we had said that your economic cost is your opportunity cost plus your explicit cost, remember? So this is going back, going back to, remember in the midterm we gave a question about Dion, and he could, I don't know if this was this year actually, but there was a guy who could enter the, okay. Sorry, I'm trying to remember which question I gave which class, but we had a question about a real estate developer who could build at some explicit cost, and also he had an opportunity cost of building versus running for president. So we added the explicit cost plus the opportunity cost, and that gave us the total economic cost. So that we're going back to that that lecture where we defined economic cost as such: explicit plus opportunity cost. Remember, your opportunity cost is the cost of the best foregone option, so it's the utility you would have gotten from doing something else. Okay, so whenever we're talking about costs in this economics class, we're talking about economic costs. Okay, so your explicit plus your opportunity cost, and that factors in because, well, I'm about to give you like 10 different definitions of what costs are. Just remember, when I give you marginal cost, or when I give you total cost or variable cost or fixed cost, ingrained in that, in the background, we're talking about economic costs. So we're talking about your explicit costs, like the things that you can see, and the implicit costs, or the opportunity costs, which are the things that are, you can't see, but they matter because they define your other choices, right? Your opportunity cost. Okay. So that said, we have the definition of accounting profit, which is a term of profit that I, as an economist, have never cared about, or I shouldn't say never cared about, because I do work in a firm and accounting profit matters for that. But as far as economists go, accounting profit is not something that we talk about very often. It's not something we really care about. But what that is just basically your revenues minus your explicit cost. So if you had a balance sheet, a list of all your expenses, and that's not really a balance sheet, but a list of all your expenses and a list of all your incoming funds. So outgoing funds minus, or incoming funds minus outgoing funds. That would be your accounting profit. Okay, everything you make minus everything you paid. Okay, but obviously, like I said, economic profit is something different. Okay, so you have accounting profit, which is just the explicit cost. Then if we add in the opportunity cost, okay, we can either have normal profit or economic profit. Okay, so normal profit occurs when your revenues minus your economic costs is equal to 0. Okay, and then if it's greater than 0, we call that economic profit. So normal profit is basically break even when you consider your opportunity cost. Okay, economic profit is you're still making money when you consider your opportunity cost. So I think this is kind of confusing. So the textbook gladly breaks it down into a little picture here, which I think is pretty helpful to think about. So if you have accounting costs here, okay, that matters for your explicit costs, okay. And then you have accounting profit, okay. So if this is your opportunity cost here, okay, your implicit costs, if you're making this much money, you have normal profit. If you're making more than your opportunity cost and your explicit cost, you're making economic profit, okay. So everything here is accounting profit, right? So this is your explicit cost. This is your opportunity cost. This is greater than your opportunity cost, okay? So explicit cost, like if your profit is, like if your revenues are below your explicit cost, you're losing money, both accounting-wise and economic-wise, okay? So your economic and accounting profit will be both less than 0. If your revenues exceed your explicit cost, okay, you are making accounting profit, okay. But if your revenues are below the sum of your explicit cost plus your opportunity cost, even though you're making accounting profit, you are not making normal profit. You are below normal profit, subnormal profit we call it. So that would be like if you're in the middle here. But if your revenue goes up above your opportunity cost, then you're making, if your revenue goes up to exactly your opportunity cost plus your explicit cost, like this point right here. Wait, I'm sorry. Sorry, I thought my mouse was on the other slide, but it was on the... Crap. Well, I'm not going to stop. So let me rephrase that. So up to this point, if your revenues are going from here to here, you're making neither accounting nor economic profit. Once you're here, you're breaking even accounting, you're negative economic. Okay. Once you're here, you're making accounting profit, but you are not making normal profit. Come on, stay. Okay, so once you're here, like in between these two lines here, you are making accounting but not normal profit. When you are here, you are making normal profit. And when you're higher than that, you're making economic profit. Okay. So all that is, technical jargon. But the key takeaway from this is normal profit is basically break even when you factor in opportunity cost. Economic profit is more than break even when you factor in opportunity cost. And you can pretty much forget accounting profit from here on out, except in as much as it comes into the textbook. All right.